Apple ending the first trading day of the year in the red after reports said it's offering iPhone discounts in China, and UBS out with a note saying winter is here for Apple following another month of soft iPhone sell-through. Joining us now is Tony Wong from Rowe Price. He manages the firm's Science and Technology Fund, which counts Apple among its top holdings. Tony, Happy New Year. So Apple's newest iPhones don't really have a killer app until Apple Intelligence launches in China sometime this year. We know the consumer there is suffering. Seems to me it would be more concerning if they were cutting prices 3 months after Apple Intelligence launched in China. What's your take?
Yeah, well, I think that China is a very competitive market, and management's called this out before. And so I think that, it's not surprising they're doing a little discounting, especially since Huawei is like a really formidable competitor. I think that looking at the last quarter, Huawei grew significantly in unit share, and then Apple kind of stayed more stagnant. And so, like, as we look at the features, a lot of times the China market has phones that have supercharged, like fast charging batteries and really nice OLED displays. In addition, when you think about like the ecosystem, a lot of the China apps are kind of native to China, like WeChat. A lot of people use WeChat instead of kind of the Apple ecosystem apps. And so I think that this is something that we've been watching and management's called out. I do think that Apple continues to have a really good position where they are a premium brand and you can't count them out. But they do, I think, need to continue to innovate as this market is really fiercely competitive, and the China economic picture, as you mentioned, is a little bit bleak right now.
Okay, Tony, sticking with AI expectations, but broadening out, looking at enterprise, at what point do we get the moment of disillusionment that affects valuations in enterprise software, enterprise tech companies with AI? I mean, even if AI does turn out to be big, it seems like most technologies, in the markets go through this trough of disillusionment.
Yeah, I think it's a great question, especially after we've seen big stock moves over the last kind of 3 to 4 months. And so I think what's really exciting, though, going forward is agentic AI, where you have these more autonomous acting AI agents that can do decision making and do a lot more than just kind of routine automation. And so when I think about like the valuations, most of software isn't at extremes. And so I think there continues to be like more reasonable expectations. And if agentic AI does really take off, we could see like a lot more kind of excitement around the AI at the application layer specifically.
So you'd be shifting more of your AI investments there. I ask because I know capital spending by hyperscalers reached an annualized level of more than $200 billion in Q3, and Goldman's estimating that AI spending will rise another 35 to 40% this year.
Yeah, I think it just depends on where you go. Can't make a blanket statement that every software company is really well positioned, but I think that over the next 5 to 10 years, what matters is that what platform companies use to build AI on and have their data that is not just siloed in a specific area. So, companies like Microsoft or ServiceNow and maybe Salesforce have a lot of the customer data and can stitch that together to drive ROI for customers. And so, I think that one thing that I've been thinking about is just like probably the companies with a lot of data, a lot of compute, a lot of scale and customers can do well. And the risk of disruption may be a lot less than people thought a year ago because of the cost to kind of deploy AI and train the models.